December 27th, 2025, silver touches $84 per ounce, 45 years of resistance, shattered. Then December 29th arrives, 11% evaporates in a single day, 67 million ounces, liquidated in minutes. But here's what they're not telling you. The Chicago Mercantile Exchange made one quiet decision, a decision with a 45-year precedent, the same pattern that destroyed fortunes in 1980, the same mechanism that crushed the 2011 rally, and now it's happening again. But this time, there's something different, something the institutions didn't account for. China just changed the rules, and the paper market may no longer control physical reality. And what happens next will determine the future of wealth preservation. Welcome to Currency Analyzer. If you've spent decades building your wealth, if you understand that markets don't move by accident, if you recognize patterns that others dismiss as coincidence, then you're in the right place. This channel exists for one purpose: to deliver the strategic economic warnings that serious decision makers require. No entertainment, no hype, just analysis. Now, if that resonates with you, do something important. Press that subscribe button. Think of it as securing a seat at a table where real market intelligence is discussed, the kind of information that institutions reserve for their premium clients. You wouldn't ignore a warning signal in your business. Don't ignore this one either. Subscribe now, and before we continue, we'd value knowing where in the world you're watching from. Drop your location in the comments. Are you monitoring these markets from North America, Europe, Asia, or elsewhere? Your perspective matters, because what we're about to reveal affects every corner of the global economy. Now, let's examine exactly what happened when silver's historic rally met institutional intervention. December 27th, 2025, a date that precious metals analysts had been predicting for years. Silver, the metal that had languished in the shadows of gold for decades, finally broke through a ceiling that had held firm since 1980. The price touched $83.60 per ounce, then climbed higher, $84, a new all-time record. Traders around the world watched their screens in disbelief. For 45 years, silver had failed to surpass the peak set during a historic episode in 1980. Now, that barrier had shattered. The rally that brought silver to this moment had been nothing short of extraordinary. At the beginning of 2025, silver traded around $20 per ounce. By late December, it had surged 190%. Gold, typically the leader in precious metals rallies, had gained approximately 67% over the same period. Silver was outperforming dramatically. But something even more remarkable was happening in Shanghai. The physical silver market told a story that Wall Street wasn't fully comprehending. Chinese investors were paying premiums exceeding $8 per ounce above London spot prices, the widest premium spread on record. On December 24th, the Shanghai Gold Exchange closed silver at $78.49 per ounce, nearly $7 higher than COMEX futures in New York. Physical demand was overwhelming supply. Refineries couldn't keep pace. Industrial users were scrambling to secure inventory. Solar panel manufacturers, electric vehicle producers, electronics companies, all competing for the same limited supply. The fundamental picture appeared unshakable. Global deficits, persistent industrial demand, monetary policy uncertainty, geopolitical tensions. Every traditional driver pointed toward higher prices. Then, December 29th arrived. What happened next would be studied by market analysts for years to come. Within hours of the opening bell, silver began to fall, not gradually, not in an orderly fashion. The price collapsed, 11% evaporated in a single trading day. From the record high of $84, silver plunged to approximately $74.76. It was the steepest single-day decline since September 2020. Gold fell simultaneously, dropping 5% to $4,240. But the focus remained on silver. The white metal's volatility had always exceeded gold's. But this was different. This wasn't normal profit-taking. This was forced liquidation. Over 67 million ounces in paper contracts were dumped onto the market within minutes. The selling pressure was mechanical, relentless, algorithmic. Traders who had watched silver climb for months, who had analyzed the fundamentals, who believed in the supply deficit story, suddenly faced margin calls they couldn't meet. Their positions were liquidated automatically. No choice, no negotiation, no mercy. The timing raised immediate questions. Why now? Why at the peak? Why during the holiday season when liquidity was already thin? The answer came from an announcement that had been posted quietly on December 27th. The Chicago Mercantile Exchange, the institution that controls the COMEX silver futures market, had made a decision. Effective December 29th, margin requirements for silver futures would increase. The requirement for March 2026 silver contracts jumped from $20,000 to $25,000 per contract, a 30% increase overnight. Each COMEX silver futures contract represents 5,000 ounces of silver. Traders who were leveraged, who had used margin to amplify their positions, suddenly needed to post an additional $7,500 per contract. Those who couldn't meet the new requirement faced automatic liquidation. Their silver was sold, regardless of their long-term conviction, regardless of the fundamentals. This wasn't the first time the CME had raised margins on silver. Just 2 weeks earlier, on December 12th, they had implemented a 10% increase. That first increase had barely registered. Prices had continued climbing, but history suggested something different was unfolding. Market veterans recognized the pattern. First margin hike, minimal impact. Second margin hike, cascade begins. It had happened before. Twice. In 2011, the CME raised silver margins 5 times in 9 days. The price crashed 30% in weeks. In 1980, the introduction of Silver Rule 7 destroyed a corner on the market. Silver fell from $50 to $10.80. Now, in late 2025, the pattern was repeating, but this time, there was a critical difference. Something the paper market controllers hadn't fully accounted for, something that would challenge the very structure of price discovery in precious metals. The physical market, particularly in Asia, was beginning to decouple from the futures market in New York, and that divergence would determine whether this sell-off represented the end of silver's bull market, or simply the beginning of a new phase, one where paper contracts and physical metal no longer moved in lockstep, one where reality would eventually overpower manipulation. The Chicago Mercantile Exchange operates from a fortress-like building in downtown Chicago. Inside, algorithms process billions of dollars in transactions every second. Traders from around the world place bets on everything from corn futures to currency swaps and precious metals. The CME controls COMEX, the world's most influential silver futures exchange. When COMEX speaks, the silver market listens. When COMEX changes the rules, fortunes are made and lost. What happened on December 29th, 2025 wasn't random. It was calculated, and it followed a playbook written 45 years earlier. To understand the December sell-off, one must first understand a story from Texas. A story about 2 brothers who believed they could corner the silver market, Nelson Lamar Hunt and William Herbert Hunt, the Hunt brothers. By the late 1970s, these men had made billions, oil, real estate, cattle, sugar, but they wanted more. They believed inflation would destroy the dollar. They believed silver was the ultimate store of value, so they began accumulating. At first, they bought physical silver, bars, coins, vault storage, but physical purchases had limits, so they turned to futures. Using margin, they could control far more silver than they could afford to buy outright. Each futures contract required only a small deposit, but gave them the right to demand physical delivery, and demand physical delivery they did. By early 1980, the Hunt brothers controlled over 200 million ounces, nearly half the world's deliverable supply. Silver prices exploded from $6 in January 1979 to nearly $50 in January 1980. The Hunt's paper wealth reached billions. They appeared unstoppable, but the regulators were watching. The Commodity Futures Trading Commission grew concerned. The CME grew concerned. The Federal Reserve grew concerned. Then came January 7th, 1980. The CME introduced Silver Rule 7. The rule was simple and devastating. It eliminated the ability to buy silver futures on margin. Traders would now need to post nearly 100% to cash. No more leverage, no more borrowing to buy. If someone wanted to control a silver contract, they needed the full cash amount. For the Hunt brothers, this was catastrophic. Their entire strategy depended on leverage. They had used their existing silver holdings as collateral to buy more silver, a self-reinforcing cycle, but Silver Rule 7 broke the cycle. Simultaneously, Federal Reserve Chairman Paul Volcker raised interest rates from 11.75% to 20%. Borrowing became impossibly expensive. The Hunts couldn't post the required margin. On March 27, 1980, they missed a margin call. Silver Thursday, as it became known, the price collapsed from $50 to $10.80. The Hunt brothers were financially destroyed. Bankruptcy followed. Their empire, built on silver, disintegrated, but the story doesn't end there. Fast forward 31 years, May 2011, silver was trading near $50 per ounce again. The metal had quintupled in less than 3 years. The Federal Reserve's second round of quantitative easing, QE2, had flooded markets with liquidity. Investors sought protection from currency debasement. Silver became the preferred vehicle. Then, between April 26th and May 5th, 2011, The CME raised margins five times in 9 days. The initial margin for a single silver contract jumped from $5,000 to $21,600, a 332% increase. Traders who had used leverage suddenly faced a choice: post massive additional capital or liquidate. Most chose liquidation because most didn't have the capital. Silver crashed from $48 to $30, a 30% decline in weeks. The pattern was identical to 1980. First, allow the price to rise. Second, introduce margin requirement increases. Third, watch over leveraged positions collapse. Fourth, collect the wealth transfer from weak hands to strong hands. Market veterans in December 2025 recognized this pattern immediately. The December 12th margin hike was the warning shot. A 10% increase. Most traders absorbed it easily. Silver continued climbing. The market interpreted it as routine, but those who understood history knew better. They had seen this movie before. First margin hike, minimal impact. Second margin hike, cascade begins. And so it happened. December 27th, the second announcement. December 29th, the implementation. March 2026 contracts. Margin requirements increased 30%, from $20,000 to $25,000 per contract. Traders needed an additional $7,500 per contract. Immediately, those who couldn't meet the requirement liquidated automatically. 67 million ounces dumped onto the market. Price collapsed 11% in a single day. But here's where 2025 diverged from 1980 and 2011. In 1980, the Hunt brothers were speculators. Their demand was artificial, based purely on cornering the market. In 2011, the rally was driven by QE2 and inflation fears. When QE2 ended and the dollar strengthened, the fundamental support vanished. But 2025 presented a different scenario. Industrial demand for silver had reached unprecedented levels. Solar panel production required 20 to 30 grams per module. Electric vehicles used 10 times more silver than traditional cars. Data centers, artificial intelligence infrastructure, 5G networks, all demanded silver. Mine production couldn't keep pace. Global deficits exceeded 200 million ounces annually. And then there was China. On January 1st, 2026, just days after the December sell-off, China implemented a new policy, a silver export licensing system. China controlled 60 to 70% of the world's refined silver supply. And now they were restricting exports. This wasn't speculation. This wasn't leverage-driven mania. This was structural supply constraint meeting inelastic industrial demand. The CME could raise margins. They could force liquidation in the paper market, but they couldn't create physical silver. And that reality was about to expose a fundamental crack in the global silver market. A crack between paper prices and physical reality. January 1st, 2026. While Western financial markets celebrated New Year, while champagne bottles popped in New York and London, while trading desks sat empty for the holiday, in Beijing, something profound was happening. Something that would fundamentally alter the global silver equation. No press conference, no dramatic announcement, no headlines screaming the news, just a quiet bureaucratic implementation. China activated its new silver export licensing system, and with that single administrative action, the rules of the game changed forever. From that moment forward, any company wanting to export refined silver from China would need government approval, a license, issued at the discretion of Chinese authorities. China had quietly weaponized silver, and most Western traders didn't realize it yet. To understand why this mattered, one must understand China's silent dominance. 60 to 70% of the world's refined silver passes through Chinese facilities. Not necessarily mined in China, but refined there. Raw silver concentrates arrive from mines in Peru, Mexico, Australia, Bolivia. Chinese refineries process the material, transform it into investment-grade bars. Then, historically, those bars flowed freely to markets worldwide. London, New York, Zurich, Singapore. The global supply chain depended on this flow. It was the invisible artery feeding the world's silver demand. But on January 1st, China inserted a control valve. It could now regulate, restrict, or completely halt exports. Silver had joined a growing list of strategic materials under Chinese state control. Rare earth elements, gallium, germanium, graphite, and now silver. The implications were staggering. While the CME was forcing liquidation in the futures market, driving paper prices down, China was constructing walls around physical supply, two opposite forces colliding, and the evidence appeared immediately in price spreads. On December 24th, 5 days before the margin-induced crash, the Shanghai Gold Exchange closed silver at $78.49 per ounce. The same day, COMEX futures in New York traded nearly $7 lower. Chinese buyers were paying massive premiums, over $8 per ounce above London spot prices, the widest premium spread in recorded history. This wasn't normal market behavior. Under efficient market theory, such price discrepancies shouldn't exist. Arbitrage traders should buy cheap in New York, sell expensive in Shanghai, and pocket the difference. The spread should collapse within hours, but it didn't collapse. It widened, because the physical metal wasn't moving freely anymore. Regulatory friction, export restrictions, licensing delays. The paper market said silver was worth $72. The physical market in Shanghai said it was worth $80 plus. Both couldn't be right. Someone was mispricing reality, and that someone was the futures market. Inside the vaults of the Shanghai Gold Exchange, a quiet frenzy was unfolding. Chinese retail investors, historically obsessed with gold, had discovered silver. They weren't buying futures contracts. They were buying physical bars, 1 kilogram, 5 kilograms, 10 kilograms, deliverable metal, no leverage, no margin calls, no CME control, just tangible assets they could touch, store, own. The Chinese government understood something Western financial institutions had forgotten. He who controls physical supply controls price. Eventually, paper markets can suppress prices temporarily through leverage manipulation and forced liquidation. But when physical shortages emerge, paper markets become irrelevant. Meanwhile, in New York, a different story was playing out. COMEX warehouse inventories sat relatively stable, but the metal wasn't moving. It was frozen, trapped by regulatory uncertainty. The United States was considering designating silver as a critical mineral under Section 232, the same legal framework used for national security tariffs. This designation created legal ambiguity, export restrictions, potential tariffs, strategic stockpile requirements. Nobody wanted to move silver out of U.S. warehouses until the regulatory picture clarified, so the metal sat, registered as inventory, but unavailable for delivery. Phantom supply, numbers on a screen but not accessible metal. The divergence between paper and physical wasn't limited to price. It extended to availability. Industrial users began reporting extended delivery times. Solar panel manufacturers in Germany requested silver, quoted 8-week delivery. Normally, delivery took 2 weeks. Electronics producers in South Korea faced similar delays. Jewelry manufacturers in India couldn't secure supply at any reasonable premium. The physical market was tightening. While the paper market claimed abundance, analysts at HSBC recognized the contradiction. They had initially forecast silver averaging $44.50 per ounce in 2026, a conservative projection based on historical patterns. But as they analyzed the physical market dynamics, they revised dramatically. New forecast, $68.25 average for 2026, a 53% increase from their original estimate. Their research revealed something startling. The global silver deficit for 2025 had reached approximately 230 million ounces. For perspective, total annual mine production was roughly 830 million ounces. A deficit of 230 million represented nearly 28% of production. That shortfall had to be filled from somewhere. Existing inventories, recycling, or demand destruction. For 2026, HSBC projected the deficit would narrow to 140 million ounces. Still massive, still structural, still unsustainable long term. Mine production couldn't increase fast enough. New silver mines take 7 to 10 years from discovery to production. Existing mines were already operating at capacity. Recycling could only provide so much. Old electronics, discarded solar panels, jewelry, industrial scrap, perhaps 180 million ounces annually. Helpful, but insufficient. The mathematics were unforgiving. Demand exceeded supply. Inventories were depleting. And now, the world's largest refining hub had implemented export controls. Industrial consumers faced a strategic choice: accept price increases and secure supply, or attempt substitution. Some applications allowed substitution. Copper conductors instead of silver in certain electronics, aluminum paste instead of silver in some solar cells. But substitution came with performance degradation, lower efficiency, reduced lifespan, inferior conductivity. For critical applications, substitution wasn't viable. Military electronics, aerospace systems, medical devices, advanced semiconductors, these required silver. No alternatives existed. And those sectors were willing to pay whatever it took. The paper market could force traders to liquidate futures contracts, but it couldn't force industrial users to abandon their supply chains. It couldn't force Chinese investors to sell their physical bars. It couldn't force mining companies to produce silver that didn't exist. Two markets diverging. Paper, controlled by the CME through margin manipulation. Physical, controlled by geology, industrial demand, and now Chinese export policy. The question facing serious analysts wasn't whether silver would recover from the December sell-off. The question was, how long could paper prices remain disconnected from physical reality? And what would happen when that disconnect finally resolved? The global financial system operates on trust. Trust that prices reflect reality. Trust that markets are efficient. Trust that paper contracts represent actual underlying assets. But in late 2025, that trust in the silver market began to fracture. And the implications extended far beyond precious metals traders. They reached into corporate boardrooms, government treasuries, and strategic planning departments worldwide. Major financial institutions were forced to recalibrate their assumptions. HSBC, one of the world's largest banks, published revised forecasts that shocked the industry. Their original 2026 silver price estimate, $44.50 per ounce. Their revised estimate, $68.25 per ounce. A massive upward revision, but even more telling was their projected trading range. They expected silver to swing between $58 and $88 per ounce during 2026, a $30 range. Extraordinary volatility for any commodity, but particularly significant for a metal embedded in critical supply chains. Their analysis pointed to a fundamental tension: short-term paper market overvaluation versus long-term physical deficits. The bank's metals analyst stated clearly, prices were fundamentally overvalued based on futures positioning. But he also acknowledged likely upside spikes would persist as long as physical tightness endured. Translation: the paper market said one thing, physical reality said another, and volatility would continue until they aligned. Other institutions offered contrasting views. Saxo Bank maintained a bullish long-term outlook. They argued the December sell-off represented healthy consolidation, not trend reversal. Their analysis focused on the gold to silver ratio, currently trading around 57 ounces of silver to 1 ounce of gold, below the decade-long average of 70 to 1, but still far above historical lows. In April 2025, the ratio had exceeded 100 to 1. Silver was severely undervalued relative to gold. The subsequent rally from $30 to $84 represented ratio compression. Saxo's analysts believed further compression was possible. If the ratio returned to 50 to 1 and gold held near $4,500, silver could reach $90. If the ratio compressed to 40 to 1, silver could exceed $110. These weren't fringe predictions. They were mathematical possibilities based on historical precedent. During the 2011 peak, the ratio briefly touched 31 to 1. During the 1980 peak, it reached 17 to 1. Extreme moves in the ratio had occurred before. They could occur again. The Federal Reserve's policy trajectory added another layer of complexity. Markets were pricing in high probability that rates would remain unchanged at the next meeting, but expectations for multiple rate cuts later in 2026 remained intact. Lower interest rates reduce the opportunity cost of holding non-yielding assets like silver. They also tend to weaken the dollar. A weaker dollar makes dollar-denominated commodities more attractive to international buyers. Both factors supported higher precious metals prices. Real yields, the return on government bonds after adjusting for inflation, hovered near zero, sometimes dipping negative. This created a favorable environment for gold and silver, because if bonds yield nothing after inflation, why hold them? Precious metals offered an alternative: no yield, but no default risk either, no counterparty risk, no government promise required, just elemental value. For business decision makers, the December sell-off presented both risks and opportunities. The risk was misinterpreting paper market volatility as fundamental weakness. Companies that delayed strategic silver procurement, hoping for lower prices, might face worse shortages later. Industrial users learned this lesson painfully during the 2021 semiconductor shortage, waiting for lower prices, only to face no availability at any price. The opportunity was recognizing the paper-physical divergence. Sophisticated buyers understood paper market crashes created physical buying opportunities. When overleveraged traders were forced to liquidate futures, physical metal didn't vanish. It simply changed hands, from weak hands to strong hands, from speculators to strategic accumulators. For corporations with silver-dependent supply chains, strategic implications were clear. Solar panel manufacturers, electric vehicle producers, electronics companies all faced the same calculus: lock in supply now, even at elevated prices, or risk availability constraints later. Some began negotiating long-term supply contracts directly with mining companies, bypassing spot markets entirely, securing guaranteed delivery at fixed prices for multiple years. Others increased inventories, building strategic stockpiles, treating silver like a critical raw material, which it was, not a commodity to be purchased just in time. The geopolitical dimension added urgency. U.S. tensions with Venezuela escalated. Colombia faced potential military pressure. China-Japan territorial disputes intensified. Middle East instability continued. Each conflict, each sanction, each trade restriction created another potential supply chain disruption. Business leaders who had lived through recent crises understood COVID supply shocks, semiconductor shortages, energy disruptions. They understood the new reality. Globalized supply chains were fragile. Geographic concentration created vulnerability. China's control over silver refining mirrored its dominance in rare earths. Strategic materials could be weaponized. Access could be denied, not through military force, through bureaucratic licensing requirements. The December sell-off, viewed through this lens, was noise, a temporary paper market phenomenon caused by margin manipulation, amplified by thin holiday liquidity, resolved through forced liquidation, but the underlying dynamics remained unchanged. Structural deficits, industrial demand growth, geographic supply concentration, export restrictions, monetary policy uncertainty, currency debasement concerns, these factors didn't disappear because the CME raised margins. For investors and business planners, the strategic question wasn't, will silver return to $84? The question was, what happens when physical shortages become undeniable, when industrial users can't secure supply, when Chinese exports cease, when mine production peaks, when inventories deplete to critical levels? At that moment, paper prices become irrelevant because futures contracts can't manufacture solar panels, they can't build electric vehicles, they can't produce semiconductors. Only physical silver can do that. And physical silver is finite. The December 11% crash in this context was a test of conviction, a test of understanding, a test of strategic thinking. Those who saw only the price drop and panicked failed the test. Those who understood the divergence between paper manipulation and physical reality recognized opportunity. History suggests that margin-induced corrections don't end bull markets. They consolidate them, they flush out weak hands, they create entry points for strategic accumulation. The Hunt brothers failed in 1980, not because silver lacked value, but because they used excessive leverage. The 2011 rally ended, not because fundamentals deteriorated, but because the driver was monetary policy, which reversed. In 2025, the driver was structural supply deficit, meeting inelastic industrial demand. That doesn't reverse, that intensifies. The CME could force traders to sell paper contracts, but they couldn't force the sun to stop shining on solar panels. They couldn't force electric vehicles to stop needing silver. They couldn't force China to resume unrestricted exports. Paper markets and physical markets were decoupling. And when that decoupling resolves, the resolution will likely favor physical reality over paper manipulation. Because in the end, reality always wins. The institutions controlling paper markets may have forgotten this fundamental truth, but geology hasn't changed, industrial demand hasn't disappeared, and strategic resource control, once weaponized, is rarely relinquished voluntarily. The question facing serious decision makers isn't whether to react to paper market volatility, but whether they understand the difference between temporary price manipulation and permanent supply constraints. One creates trading opportunities. The other creates strategic imperatives. Those who recognize which is which will navigate what comes next. Those who don't will learn the same lesson the Hunt brothers learned in 1980. That leverage magnifies not just gains, but catastrophic losses. And that in markets, as in physics, reality always, eventually, prevails.